There are two key takeaways from today's event. The first is that the rental market, and indeed the housing market in general in Ireland, is one with very strong demand. The second key takeaway is that actually the solutions, the policy solutions, are very much within the reach of Irish policymakers today. It's around things like making sure construction is more efficient, doing social housing properly, and reforming the way we use land. One of the interesting things when you look at the rental market is just how strong the demand for smaller accommodation, what we typically think of as apartments, is. By my estimates, we are missing about 500,000 apartments in this country. We actually have more than enough family houses to accommodate 3 or 4 people, but to accommodate 1 or 2 persons, we're actually missing about 500,000, compared both to the structure of our own population and also compared to other countries in Europe.
Well, the key takeaway is that there's still a huge appetite in the buy-to-let market. The product is there, it's available. We need to identify the properties for these individuals to purchase.
I thought it was a very insightful and interesting seminar. The one that really got me was our need for apartment living here in Dublin in particular. It's quite stark when you look at a need for 500,000 odd units.
Ronan Lyons is very bright, very articulate, takes a complicated subject and delivers it to an audience in a way that is clear and concise and understandable. I just think he's the best in the business of it.
ICS Mortgage brand is very important to us. It's very important to have events like this for our customers and brokers to understand what we're about, and that we are the first specialist buy-to-let mortgage lender in Ireland, and it's well established and well trusted.
Good morning, everyone. My name is Fergal McGrath, and I am Chief Executive and co-founder of Dillusk, and we trade as ICS Mortgages. I would like to offer a very warm welcome to each and every one of you who have joined us this morning. I've been told that we have almost 1,000 people on the webinar, which is wonderful news. You will all see a question box on your screen where you can submit questions throughout this event, and we will be getting our panel to answer as many of these as possible after Ronan Lyons' presentation. This is our 4th year to host our buy-to-let seminar with our great partner, Professor Ronan Lyons. We believe it is essential for us all to take time out from the day-to-day business every so often and look at what is happening at a broader level with the buy-to-let market, the trends, the opportunities, the forecasts, and ultimately how this impacts the decisions we all make. When we started the business in 2014, we set ourselves a vision for ICS Mortgages to be the undisputed number 1 in the buy-to-let market in Ireland by 2020. We are delighted that we have achieved this goal, and we now have the largest share of new buy-to-let mortgage lending in the country. This is a result of the wonderful support and loyalty from our customers and our broker partners. I would like to take this opportunity to thank you all sincerely for that. The last year has been an extraordinary one for us all. When COVID hit last March, we were all very apprehensive about what lay ahead. Of course, the buy-to-let market initially slowed down, but the property market held its own, and the buy-to-let market was no exception. Rents have held strong, and in particular rents outside of Dublin, where we've witnessed a trend towards relocation due to remote working. We believe this trend will continue. We had a very strong year for both buy-to-let purchase and also portfolio refinancing, where we can offer bespoke solutions for clients. We know that there are certain cohorts exiting the market, but this is offset by new investors entering and many with multiple purchases. So it is now time to commence our seminar, and I'm delighted to introduce you to our panel of experts this morning. We have Margaret McCormack, who joins us from the IPOA, the Irish Property Owners Association. The IPOA represents over 1,600 residential landlord members, and Margaret has a wealth of knowledge and expertise in the rental property market. We're also joined by Rowena Quinn, Managing Partner at Hunters Estate Agents. Hunters is a boutique agency in Dublin, offering a variety of services, including sales, lettings, property management, and valuations. We also have Angus Burns, partner in Grant Thornton, one of the country's leading accountancy practices. Angus is also director of Grant Thornton Pensioner Trustees, who provide self-administered pension structures for clients who wish to purchase investment properties in a tax-efficient manner through their pension. Coleman O'Connor joins us from O'Connor Shannon Estate Agents. Coleman has a considerable level of knowledge and expertise in residential investment markets and specialises in the pre-63 multi-unit market. And finally on the panel, we've Breen Purcell, partner in Field Fisher Solicitors, one of Ireland's leading law firms. Breen specialises in real estate and advises on all aspects of property law to commercial and private clients. Field Fisher are also active in the area of social housing, acting for the Housing Agency and a number of local authorities. So that's our panel, and I will now hand you over to our guest speaker, Professor Ronan Lyons. Ronan needs no introduction. He is an expert in the rental market, and I will leave you in his capable hands for the next 40 minutes.
Got to unmute myself there. The classic error of 2020 and 21, the COVID era. Fergal, thanks so much for that introduction, and thanks for having me again. And remarkable that we've so many. One of the upsides, I think, to having to do so much online is that we can I suppose attend a lot more and see things you otherwise wouldn't have got to see. So what I'd like to do with my time with you today is go through the short-term outlook for the housing market with a particular focus on rental, and then also not forget the medium to longer term look. So if you saw the video there before we got started, those themes haven't gone away, and it's worth digging into those and seeing how many of those have worsened or improved over the last 3, 4, 5 years. There's going to be lots of questions that perhaps I don't address directly, so feel free to bring them up in the Q&A. There's 101 questions you might have about how COVID could affect the market. So please do, if I don't mention something, or if I mention something in passing and you want us to go into it in more detail in the discussion, feel free to ask the questions. So now I'm going to use my fancy clicker here. We were going through this earlier, very impressive. Use my phone to go from slide to slide. I'm still wowed by the technology. So I start with, in some ways, a bit of a punchline. What is the gross yield on residential real estate in Ireland today? So what the figures that go into this, there's an awful lot going on the slide, so we can take a minute or two to go through. What you see is for any particular dot, and I'll get back to the dots in a second, you see the annual rent as of the end of 2020 compared to the average price of a particular property type in a particular location. So it's a gross yield, and of course, if you're talking to Angus or others, you might have a way of making sure the gross and the net yield are pretty much like for like, or indeed, if you're going through a different setup, you'll have to make an adjustment for that. What it does show is that for property that's already built, the yield for residential real estate, it can be quite high, especially for smaller homes. So now if we look at those dots, if you take any particular locations, so if you take, say, Cork City around about the middle, or Dublin 4 at the top, or Leitrim over on the far left, you'll have 4 dots. And in every single case, you've got 1 beds offering the highest gross yields, 2 beds next, 3 beds next, and 4 beds offering the lowest yields. And you could put in 5 beds, it just makes the chart a bit busier, but 5 yields are slightly below 4 beds, but pretty much the same level. Now, that's one dimension. You can take any particular market, and you can see if you look at Leitrim or Roscommon or Longford, 1 beds have gross yields at the moment of something like 12%, 2 beds are about 10%, and 3 beds are between 8 and 10% in those markets. And then there's a huge gap between 3 beds and 4 beds. in those markets. As you move from left to right, what's happening on that chart is you're going to areas where property is on average more expensive. So they're sorted from left to right by how expensive a 3-bed semi-detached property is. So that's why Leitrim, Roscommon and Longford are on the far left, and over on the far right you South Dublin County, Dublin 6 and Dublin 4. And you can see what happens is the 4-bed doesn't really change that much. The yield goes from maybe 5% to maybe 3%, which I suppose is a big change. You know, if you're in that level, 3% versus 5% matters quite a bit. But really the bigger difference is the spread of yields as you get into those higher value markets. Typically, even for smaller properties, the yield is going to be a good bit lower. And you can sort of see a bit of a reset halfway through the chart, and it's not by design, but it does reflect that Dublin is sort of one collection of markets by itself. The most expensive 25 markets in Dublin are in Ireland are in Dublin, and then as you move out, you actually see Dublin 17 is the cheapest market in Dublin. It's a little bit more expensive for a 3-bed semi-detached property there than it is in Cork City on average, which of course hides important differences within Cork City. But if you just take the kind of 54 top level markets in the country, the various parts of Dublin, the 4 other cities, and then the 25 other counties, you can see as you go more expensive outside Dublin, you're getting these lower yields on average, and then as you go within Dublin, it's even more pronounced. If you're looking at Dublin 22 or Dublin 10 or Dublin 24, you could be talking for 1-beds of gross yields something like 10 or 11%. But if you're looking at Dublin 6, even a 1-bed would only, in inverted commas, get you a gross yield of 6%. But that 6% in the 1-bed segment in Dublin 6, which is the lowest yield for a 1-bed in the country, is still above the highest yield for a 4-bed, which is actually Dublin 17 is the highest yield for a 4-bed. But even if you look across the rest of the country, there isn't really the same pattern for 4-beds. And this, I'm not going to spend this long on every slide, obviously, we wouldn't have the time, but this I think is a key point in the market. Firstly, there's a clear signal from this market in line with what I was saying in the clip beforehand. Of all the types of homes we have in this country, homes that fit smaller households, 1 and 2 persons, show, by these metrics, they show the biggest need. So some people say to me, if I say, oh, well, we need to build hundreds of thousands of 1 and 2 person, 1 and 2-bed apartments or homes for 1 and 2 persons, people say, well, where are we going to get these 1 and 2 person households from? They're there. They're just getting hidden in the housing system we have at the moment. And the second, that's one thing, is that the kind of the top to bottom, there's a clear signal coming from the market. The second thing that comes from looking at this is less about demand, I think, and more about how the investor thinks. Is that if you want to think of this maybe as risk premium or capital gains, as you go from left to right, there's perhaps more of a capital gains play and less of a return on an annual basis. That people are buying properties, if they're buying them as investments in Dublin 6W or Dublin 14, they're not doing them for high yields on an annual basis, so they must be doing them because they think those locations will hold their value best. Or you put it the other way around, if you go to Dublin 22 or if you go to Roscommon or Longford, the kinds of yields that will attract an investor are significantly higher. So either it's a capital gains thing in the most expensive markets or a greater risk premium in the cheapest markets, or probably some combination of the two. That's the second thing I would take away from that chart about location. And the last thing is with 4-beds, if you're, some of you live this, so you'll know this far better than I do. If you're in the market for a 4-bed investment property, you are competing with owner-occupiers. And owner-occupiers don't pay income tax. They don't need Angus to come along and come up with a fancy investment vehicle for them, because we give that to them as part of the state. You don't pay income tax, you don't pay capital gains tax. It is very difficult for an investor to compete with an owner-occupier on that basis. If we were doing this chart in 2005 or 2006, 15 years ago,
we might have seen different trends. We might have seen a much tighter gap between, say, a 2-bed and a 4-bed, because owner-occupiers were going into kind of a ladder mentality. I'll buy a 2-bed for a few years, and then hopefully the equity gains from that will get me the home I want for the next 15 or 20 years. They don't do that anymore, so we don't have owner-occupiers competing with investors. And that's another thing that drives the yields for 4-beds so far below what they are for 1, 2, and 3 beds. So that's in some ways, if you were here for the yields, you can have a snooze now for the rest and maybe wake up for the panel discussion. And there's obviously, hopefully I can keep you awake with some more interesting stuff. If we go to the next slide, this is just the picture of the market. So here I'm using daft.ie report data, but it looks the same if you use the CSO information there. On the left-hand side, you see the level of prices by market, by region. And on the right-hand side, you see either quarterly or annual inflation. The annual is on the right-hand side there. So you can see prices were falling 15 or 20%, 2009, 10, 11, and then swiftly turned around to rising. And before COVID, if we were to describe the sales market, we would have said it was coming back into balance between supply and demand. So the pipeline of estate housing that was getting built predominantly for mortgaged owner-occupiers was roughly in line with the pipeline the mortgage industry could produce of owner-occupiers. So we saw very little upward pressure in prices. COVID kind of upended that, because as we'll see in a couple of slides' time, it disrupted the supply of sales property all across the country. So there's about 1/3 fewer homes put up for sale in the last year than there had been in the previous year. So that's a 33% fall. It varies from a little bit around the country, kind of 30 to 35%, though pretty much everywhere. That fall in the volume of properties for sale at a time when demand has held up remarkably well on the sales side. As you can see, if you look at those last 2 bars, and big increases in, on the right-hand side, the last 2 blue bars, big increases in the 3rd and 4th quarters in terms of sale prices nationally. And there are some differences around the country, that is true. Typically, the cities outside Dublin, the cities other than Dublin, have seen the biggest increases. The rest of the country outside Dublin, so the smallest, so next biggest, and then Dublin, so the smallest increase. But we were still talking about increases in terms of listed prices. If we look at the rental segment and do the same kind of graph, you can see that firstly, the increases over the last 10 years have been much bigger. And that's like a yield correcting story. If you take where we are now compared to where we were 15 years ago, rents are a lot higher. Rents are about 1/3 higher than the Celtic Tiger peak. Sale prices are still about 1/4 or 1/3 lower. And that varies quite a lot, actually, if you go around the country where prices are now compared to 15 years ago. Not that that's relevant if you're 28 or 32 now and looking to buy a home. Who cares what prices were in 2005 or 2006? But it does tell us something about what corrected in the market in that point in time. And the other thing is, if you go back, you can see this double dip in the yellow there on the right-hand side, the double dip of sale price falls, but a single dip of rental price falls. And the way I kind of think about that is both sale and rental markets had to correct because of an income shock. People became unemployed, people lost their jobs, especially in construction and other sectors. In the public sector, they lost part of their incomes. All of that feeds through into both sale and rental markets as fundamental demand. But the sales market had to do a further correction on top, and it goes back to the yield story. If you do that yield over time, you see that yields on real estate were something like 3 or 3.25% on average in 2006, early 2007. And they had to correct up to something like 6% overall national average. And that yield correction story is the second dip on the sales side. But moving to more recent trends, you can see that actually, if we were talking about this 15 months ago, as we did indeed, we had an event in January 2020, and we were talking about the market at the time, we were talking about the sales market being in balance, but rental market still being undersupplied and rent still going up. That's flipped COVID has flipped that around, that dynamic, and now we're seeing rental markets, especially in Dublin, static or slightly falling in terms of price levels, and the sales market has gone back into increases. So we had 29 consecutive quarters of rent increases, which, when you adjust for inflation, some of my research looks at the path of rents in Dublin since the 1940s, or we're now going back into the 1860s with a new project, and the increase of nearly 8 years of a doubling of rents. Once you take out kind of wider inflation, right? The 70s was different because there was much higher general inflation. Once you look at real rents, inflation-adjusted rents, there's nothing like that on record back to the 40s. And I wouldn't be surprised if there's nothing like that on record back to the 1860s when we get those figures. So that was an unprecedented period of rental growth that COVID has ended. I guess the key question is, has COVID ended it for good, or is it just a temporary respite in a market that is chronically starved of housing supply? And that brings me on to, we can talk about prices a lot, but really we want to understand what drives price trends. And if you look at the availability of rental property, look at the blue line there on the left-hand side. That's the number of homes available to rent on the first of each month in Dublin, going back to 2007. And you can see that blue line is very low for most of the period 2015 to 2019 into 2020. And then over the last 12 months, it's roughly doubled. Now, it's still low availability relative to what the market was used to pre-2013. In fact, with Dublin, you can go back with DAF data to 2001 or 2002, and you can see that that level of the tightness of supply or availability in the late 2010s was unprecedented. There was nothing like it. The rental market in the early 2000s had its tight period, certainly, but nothing like what happened in the late 2010s. So COVID has managed to bring about an increase in rental supply, and then the opposite effect in sales supply. So again, if you look at the blue line, it's most obvious in the Dublin market that there had been this improvement in sales supply in 2018, 2019, and COVID has had the opposite effect. If you think about this from a level 5 lockdown point of view, it's quite difficult to sell your home in level 5 lockdown. Right? So people are not putting their homes up on the market. They're worried about not getting the right mix of people in, and therefore they're not going to sell it for the right price. So they're going to hold off and sell it later on. So in level 5 or in lockdown or whatever it's called at different points in time, typically you'd see sale listings down by 50 or 60%. Maybe sometimes in last April, May, June, I think it was down 80 or 90% at different points. In the rental market, we had the opposite. We had, especially in Dublin and Galway, we had this Airbnb stock initially move into the short-term lets, move into the long-term rental market. Even though that was a one-off transition and it's happened and it's unlikely to reverse, I don't think we'll see that much going back, because Dublin City Council has passed their regulations and they're kind of aware now of what's moved over. So I think it'll be trickier to move back. Nothing will, but just generally trickier. But that was only a one-off transition. But liquidity feeds liquidity. So if nobody's moving because rents are high, then nobody moves and rents stay high. If you get this injection, a one-off injection of additional property into the market, and you have, for whatever reason, in this case COVID, you've got very limited new demand coming in to the rental segment, and we can come back to that. Say you've got 100,000 renters and you get an extra 5,000 properties. 5,000 move, but the 5,000 properties they were in now become available, and another 5,000 move. And that kind of reverberation, that recirculation of properties has helped bring rents down a little bit from what had been, I think, an artificial spike in terms of rent levels overall in the market. And because if leases had gone from 12 to 18 months to kind of 3 to 5 years on average. And when you think about who rents, renting is dominated by students and young professionals. 3 to 5 years is a very long tenancy period for those kinds of age groups. And you can get artificial immobility, which doesn't suit anyone. So the price trends flipping, rents stopping, no longer going up, and sale prices going up again after a kind of reversal of the 2019 trends, comes from the supply trends. And that in turn comes from the differential impact that COVID has had on listing a property for rent or listing a property for sale. I think it's also, and I'll come back to this at the end, it's also worth thinking about the differential impact COVID has on demand. We can talk about the, Dublin versus other parts of the country later on. But if you think about sale versus rental demand, a lot of the rental demand at the margin comes from people who are moving out from their parents' home or moving to Dublin or to Cork because they're taking up a job and they might be coming from outside the country. None of that is happening at the moment. But on the sale side, the people who buy homes in Ireland, the people who buy homes as owner-occupiers, they do so typically secure in employment in Ireland. And many or most of those have stayed in secure employment in Ireland over the last 12, 15 months. So sales demand has been relatively unaffected, and rental demand has been, in my view, temporarily dislocated or paused. So there's both different supply dynamics and different demand dynamics. That's the current picture. And the last thing I would say, often you hear people, I won't name names, but you hear people on the airwaves, and they say, oh, the housing's too complicated. It's supply and demand doesn't work. There's much more going on than that. And when I hear that, I think of this graph, or these two graphs. On the left-hand side, you have in the sales market, and I've picked Dublin because it's kind of a coherent market. You can do the same thing for other, for the country as a whole, or for other markets, and you get the same picture. But it's the number of homes on the market on the first day of a quarter, and then what happens, sale prices on the left-hand side, or rental prices on the right-hand side in the following year. So unsurprisingly, the more homes that are available for sale, the less upward pressure on sale price. So you can see there's this kind of lovely neat downward scatter on the left-hand side, a little bit messier on the right-hand side, but the same general idea. The more homes on the market at any particular point in time, the less upward pressure there is. And that's why when you take off supply in the sales market, you're much more likely to see prices go up. And when you put on additional supply in the rental market, as happened in the last 12, 15 months, you're more likely to see rents go down. Now, I focused quite a bit on Dublin. Probably the places that have seen the biggest increases across sale and rental markets over the last 12, 15 months have been the other four cities, Cork, Galway, Limerick, and Waterford. They have seen sale and rental price growth more than rural areas of the country and more than Dublin. And of course, in Dublin, we've seen rents fall. And that tells us something about the spatial element of demand and how COVID may be changing that. Not the kind of the Irish politician's dream of lots of people will suddenly move into marginal constituencies and they'll be able to claim the credit at the next election. Instead, it's more to do with city-to-city competition, which is what we've seen in the US. We've seen, and indeed, I suspect we'll see it elsewhere in Europe as well. Cheaper cities become more attractive for people to live in when they are less tied to the being close to their workplace. And I think that gets to I'm probably biased as an urban economist. I'm going to say things like this, but cities are not just where we work, they're where we live as well. And the variety of amenities you get in a city, people like. The higher your income is, the more likely you are to want the collection of amenities a city gives you. So that means that when people are looking, where will we go now that COVID has freed us up, even if it's only temporarily? And renters are going to be particularly susceptible to this because if they need to move back to work, they can give their notice in and move again. Notice that they're picking cities. They're just picking the cheaper cities. And there's a huge amount to be gained if you're a renter. If you can make it work, for example, if you can live in Galway, go to Dublin once every 2 or 3 weeks for the team meeting or whatever it is, but you get to enjoy a city life, but at maybe half the cost in terms of rent, and maybe a more walkable city as well. Ambassador for Galway today. That's the kind of thing that I think will get reflected in the rental market. The sales market might be slightly different because we have a backlog of people with very long commutes, and they may want to unlike other parts of Europe, we are going to have people who are more likely to try and lean into the work from home. I see there's kind of a difference of opinion in the cabinet. Leo Varadkar, I think, wants to have really generous tax credits to encourage people to work from home. And I think it's Pascal Dunne who is saying, well, actually, offices do more than just, house your computer. It's where you form your networks, your skills. If you're new in employment, it's how you get to know the ropes. How do promotions work if nobody ever meets each other? How do you form those relationships? So there's a lot more to COVID than just, I don't have to go into the office anymore. And perhaps maybe after a year, lots of us do want to get back into the office. I'm guilty as charged. I'm in Trinity as we speak. So to move into the kind of the slightly bigger term picture for the next 10 or 15 minutes or so, this is the number of homes completed around the country since the start of 2015. And you can see if you add up all those bars along the bottom, we're definitely improving. And there was a lockdown fall off in Q2 2020, but there seems to have been a rebound. Pretty much everything that got put off in the second quarter of 2020 got completed in the third and the fourth quarters. But despite the fact that in the fourth quarter of 2020, we built more homes than at any point in the previous 10 years, it's still well below what I would think of as the underlying housing need. I've kind of drifted away from talking about housing demand because you get into scraps with people and they're like, but if prices are falling, supply must be greater than demand. I kind of think of it as, well, where do we as a country need to be in the 2040s or 2050s in terms of our housing stock? And then let's work from there. Right? So if we are a country of 6.5 million people in the 2050s and we're in households of, say, 2.2 or 2.3 people on average, and both of those things seem reasonable where we are now, where our European neighbours are now, then that means we need something like 45 to 50,000 homes a year if we're going to get there by mid-century. If we want to kind of prolong the housing crisis and say, well, look, we'll sort it out by 2100, then you could have a lower level of completions because population growth will probably peak in the 2080s. And those last 2 decades will be grand. But I'm not going to wait around. I don't particularly think we should be waiting around for things to solve themselves in the 2080s or 2090s. I'm pretty sure I'm not going to be around then. It'd be nice to talk about a healthy housing system at some point in my career. So let's try and target it for just around the time I'm retiring, sometime in the 2050s. That kind of housing need bit there, that's the solid red line is 40,000 a year. The dashed line is 50,000 a year. And you can see we're well below. And that's social, rental, and owner occupied, all added up. We're still well below what we need to be. And it gets worse, right? Because this is, as I mentioned, I've been doing my digging into the historical stats. This is how many homes have we been building per household over the last 5 years. And you can see in the late 60s and early 70s, Dublin, the blue line there, had a bit of a building boom and was completing something like 3% of dwellings per household over the course of a 5-year period. It went down to 0.3% at one point. It has come back up. If you take those red bars, those are the red bars from the last slide, and you can see how far below underlying housing need we are and how far below historical trends we are. And I've separated Dublin and the rest of the country there. You can almost pinpoint when Dublin, and I'll show you the price evidence for this, you can almost pinpoint when Dublin started underbuilding relative to its housing need. And it's when the blue line crosses below the green and the yellow lines there in the late 1970s. With a partial exception in the 1990s when nobody was building anything, more or less, Dublin has been underserved in terms of new housing supply. And therefore, you would expect Dublin to be becoming more expensive. And this is the thing, many of you are probably experienced investors and you'll know this trend. But if you look at that price of Dublin housing, and Dublin here is kind of a placeholder for all the cities in the country. It's the most extreme version. This is also true if you look at Cork City and Galway City, and to a lesser extent, Limerick and Waterford cities, that the cities have become more expensive only in the last generation or so. This, when you say this to someone in their 20s, it kind of blows their minds because they just have grown up thinking that cities are by definition more expensive. And that's true on a per acre basis, but we can build up. We can build more densely. You don't have to have not the per acre bit, but the per square meter of living space bit doesn't have to be any more expensive in cities than in other parts of the country. It's just an artifact of not having built enough homes in the last 25, 30 years. And that in turn is a problem of growth. That without getting too big picture, from the 1840s to the 1990s, Ireland didn't really have a business model. Its business model for the previous 100 years was sell food to people, in particular the Brits. And from the 1840s to the 1990s, there wasn't really a business model. They tried selling beef, and then the Argentinians got in the game, refrigerated transport. And then it was, well, let's try doing our own manufacturing from the 30s to the 60s. It was only in the 80s and 90s that Ireland came up with its new business model to act as a launching pad for North American firms into the single European market. But once you find a business model, you're going to be growing. And once you grow, you need to have the infrastructure, including the housing, to grow with it. And that's what Ireland hasn't been able to provide. Housing prices were stable in the 70s, 80s, and into the early 90s because there wasn't a lot of growth. Housing prices, housing prices have been rising since then because there's been lots of growth in employment, in income, but there hasn't been enough growth in housing to compensate. And I think the bubble is a bit of a distraction in that, because anytime I talk about this, people are like, well, what about the mid-2000s? Well, actually, the mid-2000s was a credit bubble, right? And obviously it's going to push up prices. But if it hadn't been for the credit, if ifs and buts and so on, but if it hadn't been for the credit, all that new supply would have pushed prices lower, not higher. So supply was doing its job, credit was just drowning it out in the early to mid 2000s. And you can see, this is not about, sometimes Irish people think, well, you know, it's great that everyone gets to go to Dublin or maybe Cork or maybe London or whatever for a couple of years, but ultimately everyone wants to go home, and set up home. Right? The problem is that may have been true in the 60s and 70s, was lots of people coming to Dublin, and then whether they stay or not is a different question. Now, we have a critical mass living in Dublin who are from Dublin, and when you tell them to go home, that's home, and there isn't enough homes for them to stay in Dublin. So Dublin has become a net exporter of people within Ireland. And if you look at the chart on the right-hand side there, that's the fraction of the population born in Ireland, but not in a county of residence. So in 1981, roughly 1 in 6 people in Dublin was born outside Dublin. These are the people coming to Dublin. And the same is true actually for the rest of the country. Since then, Dublin has become more exclusive, believe it or not. And now only about 1 in 8 people who are Irish, who live in Dublin, were born outside Dublin. But actually, if you go to the rest of the country, about a quarter of people who are Irish, who live in a particular county, were born outside of that county. And guess what? The vast majority of them are Dubliners. So we are now shipping Dubliners to the rest of the country. If that's not a way to get the rest of the country to agree to get more housing built in Dublin and Cork, whatever about Dubs, the Corkonians, please think of the Corkonians being exported and the people being subjected to Corkonians in their neighborhoods. This is the result of a failed housing system where we're no longer able to accommodate the growth. And you can see on the left-hand side there, a chart I showed a couple of years ago, it's how urban every country is. And Ireland was one of the least urban countries in Europe in the 1960s. That made sense. It was basically an agricultural exporter. We're still one of the least urban countries in Europe now, even though we are specialized in services, which cluster more than even manufacturing does. So we should be more urban than the average, but we've stayed more agricultural. And that's a failure of housing, not some sort of unusual preferences on the part of Irish homeowners. That's the location. The other one is the average household size. And here, and again, there's people who disagree with me. For me, this is kind of like it's really hard to disagree with this chart. This is the average household size, and the black line there, which stops abruptly in 2011, is the actual household size in Ireland. And weirdly, it stopped falling just as we stopped building homes. That doesn't seem to me to be a coincidence. Although you'll have some people who will try and tell you, oh, no, household size has stopped falling. And we just happen to change our preferences at the same time we stop building homes. The trends there are the dashed line and the grey line tell you that we, if the housing had been adequate, we would be down at kind of 2.5, 2.5, or maybe 2.4 in terms of underlying household size. Would that be kind of out of line? Absolutely not. My estimate is that the true underlying household size in Ireland, when you take the Crammer households and redistribute them, these are the unrelated persons living together in a 3 or a 4 bed because there isn't the housing for them, but the true household size in Ireland is around 2.4. And that would put us still in the top 5 in Europe, just not kind of the laggard out at the very end. And it's the lack of housing that drives us up there. And as I mentioned in the clip at the start, this is I'm plagiarizing myself here. I think this is almost identical to the slide I presented a couple of years ago. It's the fraction of dwellings that are in apartments in Ireland compared to other countries. And I've only included the countries there on the right-hand side, but you can actually do it by regions within countries. And if you do it by regions within countries, Ireland still comes out at the very bottom. And the Shetland Islands, I think I did mention this a couple of years ago, the Shetland Islands has more of its housing in apartments than Ireland does. So this is not about, well, whatever is good for the Netherlands is fine for them, but we're just different. This is about Ireland is just unable to do the kinds of housing that we need. And on the left-hand side, what it shows is the number of households and the number of dwellings of particular sizes. So red is the number of households or dwellings that are 1 or 2 persons or would fit 1 or 2 persons, 1 to 4 principal rooms in the census. And the green is the number of what you might think of as families, and 3 to 5 persons or 5 to 9 rooms. The reason I say families is not because I don't believe in the unit of the family, but a lot of those 3 to 5 person households are 3 young professionals living together or 5 students living together. We're actually overcounting the large households in the chart on the left, and there's still a surplus of family homes. In fact, there's no population projection I've seen where we will ever have more families than we have family homes right now in the country. So I'm not saying we should ban building family homes, but we should certainly be encouraging the system to build all the other kinds of housing you might need in a life cycle. And that's the note I'll finish on in a couple of minutes. A couple more things I just wanted to cover. There's an obvious why here. Why are we not building apartments if it's so obvious? If Ronan, if it's so obvious, why aren't they doing it? The answer is the construction cost. And there's a few different ways of measuring this, but it is very expensive to build housing in Ireland. It's more expensive to build upfront, more expensive to build housing in apartments than in houses, because especially in Ireland, we subsidise houses. And it's the apartments that do the subsidising in terms of the cost of utilities and so on. So in every country, it's more expensive to build smaller homes, and in Ireland, it's uniquely so. It's 30 to 40% above what it should be, and nobody can really answer why that's the case. And the problem with that is when you think about the viability of homes, and take this kind of stylized exercise of the last 4 years, those little triangles, the blue triangles there, are where rents were at the end of 2018 by micromarket. So micromarket there is Grand Canal Dock or Athenry. I think they're top and bottom in that list. So it's all micromarkets in the greater Dublin, Cork and Galway areas in terms of city areas. And those lines are, if you had to pay 100 grand for a site or 50 grand for a site, you got 2 grand per square meter in construction costs, and your investor wants a gross yield of 6.5%. So you can see there that really with land costs, it was only viable in the top end of the Dublin market. What had helped, of course, was rental inflation. Helped in inverted commas, doesn't help the renter. But you can see that as of the end of 2016, there was basically nowhere where it was viable to build apartments. And as of the end of 2020, that most of Dublin and indeed most of Cork as well, if you're only paying 50 grand per unit in site costs, had become viable. The other clever thing the government did was it changed the build to rent, introduced the build to rent code. And by having this kind of 15-year plus time horizon, it brought a whole new class of investor, not the American venture funds that are looking for 6.5%, but more like European pension funds that are looking for 4.5%. And by doing that, you bring those lines down and a lot more becomes viable or sustainable. But of course, the true answer here is to get construction costs down. So if we do actually want to build homes in Athenry or Carrick-on-Shannon or Carrick-on-Shore or Tralee or wherever it is, there's not I mean, it's a million miles from viability at the moment. But they need homes just the same as other parts of the country need homes. It's not about Dublin being too big or too small. It's actually Dublin's about the right size given the size of the country. It's the second tier is too small. The missing urbanization is in that second tier where people typically exurbanize rather than suburbanize instead. Okay, so to close and looking into the future, this is planning permissions data. We can kind of look into 2023 because apartments take so long to build. There's quite a pipeline. The pipeline of estate housing seems pretty solid. The pipeline of apartments, more or less, it didn't quite get set back a full year, but it certainly got set back 6 months and counting. So we're now talking about this new apartment supply coming on stream in 2022 and especially into 2023. Rather than 2021 and into 2022. But we are talking about significant numbers of apartments getting built. And that's the reflection of that, the build to rent rules. And that pipeline of new apartments, you can look at it by project and see what's under construction, what's been given planning, what has planning submitted, but we don't know yet, and what's pre-planning. There's actually quite a bit in addition that's pre-planning or planning submitted in terms of apartments. Most of it is Dublin. There's about less than 10% of the stock of about 35,000 build to rents are in Cork, and there's nothing outside of Dublin or Cork. So we think about that in terms of the Dublin market getting additional rental supply over the next few years. By my estimate, over a decade of no construction means that Dublin is 60 to 70,000 units behind where it needs to be. So by building 30,000 homes, it will definitely help bring rents back down to more affordable levels, but it's not going to lead to anything like a saturation, too many rental homes given the number of renters. And certainly when you take into account growth over the next 10, 20, 30 years, building 30,000 rental homes in a city of 1.5 million people is relatively small. And that we should be looking to build another 30,000 and then another 30,000 on top of that. And integrating social housing into that seems to me to be a sensible idea. Okay, so the second last thing I wanted to do was just have a quick kind of deeper dive at the COVID effect. You can see there the effect on listings, lockdown there, Dublin and outside Dublin in green, Dublin in blue, sales on the left-hand side. You can see that the initial lockdown had a really significant effect on the number of listings. But by September, October, we were pretty much back to normal. In the rental side, on the right-hand side of the graph, you can see that the gap between the blue solid and the blue dashed lines got bigger and bigger over time. Liquidity kept on having its effect. In the rest of the country, there were fewer rental listings, not more. So very, very different. Is this temporary or permanent? Well, we can look at PPS numbers that were issued. Green there is Irish. The solid line is 2020 compared to the previous 5-year average. And there wasn't a huge change in the number of PPS numbers issued. That's because most of them were issued at birth. But look at the non-Irish. Basically, COVID has stopped migration to the country. Not completely, but certainly a fall of more than 50%. In the number of people coming to the country to take up work. The jobs are still getting created. So as soon as we get past this part of the COVID blockage, I think we're going to see a big swing back to migration to Dublin and to Cork and to Ireland more generally. And if World War II rationing tells us anything, is that when you take the restrictions off, you do get a consumption boom. So in the last 30 seconds, this is the Irish housing system. Now, as of maybe 2000, you got your family home. You stay there as long as you need to. You get your own family home, then the nursing home and the funeral home, and you're gone. And that's a very uniform housing system, and it's pretty boring, let's face it. What we need to be thinking of is, yes, the family home, and yes, the funeral home and the nursing home. We also need student accommodation, co-living accommodation, there's a one, urban core rental homes. This is downsizer market homes. This is independent living. This is assisted living. These are all kinds of homes that the country lacks. So we're excessively focused on family homes. We need to kind of move beyond that. So I'm just out of time there, so I'll stop. Thanks so much for your attention, and I'm looking forward to the discussion afterwards.
Great, thank you very much, Ronan. As always, you've managed to give us some extremely interesting insights into the current state of the rental market and the dynamics within. And as we said in the video as well, you have a great ability to make the somewhat complicated very clear and concise. So we have lots of very interesting questions coming through from attendees. And I am going to ask our panel some of these questions. And Ronan, you can obviously join the panel as well. So maybe I start with Margaret. The IPOA provides an important service to its members in terms of advice and training for landlords. What are the key areas of practical advice that you have had to focus on for your members, and in particular in the last 12 months?
Thank you, Fergal. We've had a lot. The whole market was absolutely decimated. And there was a lot of concern from everybody within the market. Even people that weren't affected were concerned and worried that they would be affected. So we had an awful lot of calls in and around the sector. The temporary rent reductions or deferment of rent, they were very important, because what happened with them was that people in that situation thought about what they wanted to do and discussed it with individuals in the sector and with their own tenants. But it needed to organise it formally so that everybody was aware of what was going to happen. If it was going to be a temporary deferment, that it was a temporary deferment, for what period of time, and that the rent itself would be afterwards would have to be paid. If it was a situation where we were looking at somebody was being given a write-off, then that had to be detailed, period of time, and it needed to be clear and unequivocal. It needs to be done in writing. So we had a lot of calls in and around that sector initially. Then we also had a lot of calls around abandonment of properties and around the situation in shared accommodation. A couple of things that I'd like to see people actually be aware of, and they're questions that our members are asking us, is that if they commence a new tenancy now, particularly in Dublin, at a lower rate, are they restricted to that lower rate? And the answer to that is yes. With the rent pressure zone rules, they will be restricted to those rules. They will not be able to increase the rent except using those rules. So that's something that's really important for people to understand. The other thing that we seem to get a lot of is antisocial behaviour. And it's not excessive antisocial behaviour. It's not really the student antisocial behaviour that we're looking at. It's where shared accommodation and people are bringing friends in, maybe one or two, but there are other people in the house that are very concerned about it, because of course that they have fear of COVID and the possibility of getting it and the restrictions in place, and how they dealt with those situations. And again, with that, it's important that it is dealt with. And we are looking at them dealing with it the same way as you deal with antisocial generally. So we're looking at a formal warning to be issued, outlining the consequences of the situation if it happens again. And then if it does happen again, a notice of termination. So it is antisocial behaviour. It does cause fear, and it does cause danger to other people in the house. Another one we were looking at was just the amount of legislation. In the last period of time, we had 4 pieces of legislation. In the last 12 months, 4 pieces of legislation amending and changing the Act. So really, for us, we've been informing our members and sending stuff out around it, keeping them well informed around the situation and the difference at different times. Because some stages you could serve notices, other stages in legislation you couldn't serve notices. So just making everybody clear as to what they can and can't do during those periods. And I would say with it is one of the things that we did have is currently, can notices be served currently under level 5? And the answer is yes, they can. So notice of terminations can be served. Can rent increases be served now during level 5? And the answer to that is also yes, they can. So that's something that we get a lot of questions on and around those situations. Something else just I'll mention briefly is that when COVID hit us first, IPOA really, really active around the situation, because what was suggested was a rental holiday. And we lobbied extremely hard and outlined a lot through the media and individually as well around the situation so that it wasn't brought in, because it would have been a disaster. It would have led to debt for tenants, and it would have led to debt for landlords, because tenants wouldn't have been able to pay. And we outlined at the time that it was the state's obligation to assist people who had a problem paying their rent. It was their obligation, and they already had methods in place to deal with it: rent supplement, HAP, that sort of thing. So basically, that's the few things that I would just wanted to mention in my period. And I just, hopefully that you have a few takeaways on that, and also that if you're not a member of the association, you should be. You've hundreds of thousands of pounds invested, and you should be aware of the rules around the sector. You need to be informed, you need to be compliant, and you need to be supported. Thank you, Fergal.
Great. Thank you very much, Margaret. No doubt the importance for buy-to-let investors to be kept informed and to be clear of what they can do and what they can't do, and in particular in the past 12 months. So thank you for that. Then moving on maybe to Rowena from Hunters. There has been a significant amount of commentary about the recent demand and supply imbalance in the housing market, and Ronan alluded to it and in many slides. But are you seeing that pent-up demand across the market, and or is it evident solely in the new build sector? That's for you.
Thank you, Fergal. The pent-up demand is evident across all sectors, all price points, new homes and second-hand properties, as demonstrated by Ronan, with a third fewer sales last year. The lack of supply is fueling the lack of supply. Vendors are hesitant to put their property to the market because there is nothing there for them to purchase in the short to medium term. I think Q3, Q4 last year demonstrated that lack of supply, with many parties bidding on a particular property. And in most instances, we had multiple bidders, 3 to 4 competing, investors and owner-occupiers competing for the same product. So in essence and summary, yes, supply is very tight, and we have not seen that improve Q1 this year, partially, I suppose, due to COVID restrictions. And the concern is, will that stock be there for Q3, Q4 of this year?
Okay, great. Thank you, Rowena. Then maybe another question here regarding tax, which is no surprise. And Ronan sort of alluding to the gross yield, net yield after tax, and also competing against owner-occupier buyer, in effect, who doesn't pay tax on rental income. Completely different strategy. But there are a number of different strategies that property purchasers can deploy while investing in property, and investing in property via pension unit trusts is one such strategy and has significant advantages. So Angus, could you describe what Grant Thornton offers investors in that area and the benefits for landlords?
Yeah, I think it's coming back to that first slide had me captivated as well on the yields. Okay, and I have to say I'm very biased on the yield focus versus capital gains. And I suppose why is that? It's because of income tax rates. You know, I mean that is, as I see it, one of the biggest drivers of landlords out of the market, if you like, is the change in income tax rate. So, you know, most people earn their money from some kind of employment or business. So, in order to get into the market or to get that deposit or to even pay down debt, you have to generate monies in the first instance. So, you know, while 10 years ago we had rates that were, you know, up to 10% less income tax rate than now, we have a higher rate of 55% for some individuals. So, you know, 100,000 of earnings, you've 45,000 to play with. And that's only half the story, I suppose. Once you do manage to get your hands on a property, much harder now because of the lack of credit. Although ICS mortgages, you're making your best efforts there to address that imbalance. But even if you do manage to get your hands together on some monies for investment, you invested in the property, and you have those higher income tax rates again a second time on the rents coming in. That makes it very hard to support some debt, a mortgage. It makes your headroom much lower, and there's another reason why. I would say the primary reason why landlords have been exiting the sector. So what we do in GT is we assist in the setup and management of small self-administered pensions. And the primary asset class, I would say, for those small self-administered pensions is property. Okay, and within property, residential investment property is the most popular. Okay, so the pension is a tax-exempt vehicle. Okay, and for that reason, revenue require a pensioner trustee to be appointed effectively as a co-trustee with the beneficiary of the pension trust. At a basic level, it involves contributing monies from your employer. So whether you're an SME owner or whether you work in an organization, moving those monies that are due to you, let's say, by way of a pension contribution into a pension trust. But there's no leakage of tax on moving those monies in. So, you know, if there's €100,000 or 50,000 euro or 20,000 euro, it really is that amount of money. There's no leakage of money going in. So immediately you have twice the amount of cash to invest. Once you invest through the pension trust, there's no income tax or capital gains tax in the pension trust. Okay, so we'll go back to that first chart again that I really liked, and let's say you're getting a net yield of let's say 8%. Okay, now my net yield doesn't include tax, by the way. So my net yield is just, you know, some maybe some management company charges in the apartment block, or something to pay a property manager. Okay, and then let's say ICS gives you one of those nice buy-to-let mortgages in the pension, and I think what's the rate? Is it 4%, something like that, 4.5%?
Yeah.
Okay, so immediately then you're borrowing half. You're getting 8% return, but you're borrowing half. So effectively, you're getting a 4% margin, let's say, on the monies you've borrowed. So now you're based on yield, and I said before, I'm very biased on yield. We don't talk so much about capital gains, because I think the investor primarily is about yield. Well, now you're effectively up at a 12% return from the yield alone. We can't forget the capital appreciation. Ronan, I don't know what the average appreciation is at the moment, but let's say it's 1 or 2% in the market, and you're borrowing half the money. So now you're up to kind of 12 to 14% return. Okay, and again, there's no tax in the trust. So those kind of returns are very attractive. But why are they attractive is because you've removed the challenge of income tax in the first point. So what we're seeing is clients who are building up residential property portfolios in the pension trust. They have an eye on wealth accumulation tax efficiently. They have an eye on an income stream later on in life that'll give them a passive income, let's say, to support themselves later on.
Great, Angus. Yeah, and I guess important to highlight, really, it's tax deferral, so it's no tax, whether it's rental income or capital gains, as long as it stays in the pension. If it's sold outside, then obviously it's subject to tax. But
yeah, and look, on that point, my tax colleagues have a saying that tax deferral is almost as good as no tax, because effectively what happens is you have the time benefit. Okay, so you're able to use time of having no tax to build up the gains tax-free over time, and then at the point that you do hit the tax crystallization, well, you have a much bigger pot effectively accumulated. So your tax rate is effectively time valued away and reduced down.
Yeah, great. Thanks, Angus. Maybe Coleman, we move on to you. Your service includes valuation, sales, leases, but you have a particular niche in the pre-63 properties. So that's the Georgian buildings you see around Dublin 1, Dublin 2 and other areas as well. Very niche, but can you describe the experience of your clients, investors in that asset class in recent times, please?
Good morning, everyone. Firstly, and I suppose for the benefit of those who are maybe not be so familiar with the pre-63 type of property, we should perhaps ask exactly what is a pre-63. So typically these buildings would have started their life as perhaps a large single family home, and then they were subsequently subdivided in flats. But more importantly, the subdivision is considered an exempt development, exempt from planning permission. And that's the actual key feature. So you could say, well, how could a building subdivided in flats be exempt from planning permission? Well, if the subdivision occurred prior to the first Planning Act coming into effect, well, then it is considered exempt. And of course, the applicable date there is October 1st, 1964. People sometimes ask us to say, why are they called pre-63s if in fact the Planning Act came into effect on the 1st of October, 1964? Why aren't they called pre-64s? Well, I think it was the fact that the actual announcement that the Planning Act was coming into effect was made in pre-63, and they got the name of pre-63s, and that has stuck with them ever since. But it raises the question, so you're out looking at a typical house in flats, which is divided perhaps 10 units. How would you know whether in fact the building was divided prior to the October 1st, 64 date, or whether in fact it was divided afterwards? So it would be exempt from planning if divided before. It would not be exempt from planning if it was divided afterwards. And the answer to that is you just wouldn't know by a survey or otherwise. So you'll be relying on what's called a pre-63 declaration, which will come with the seller's pack into your solicitor's office with title documents and the contract. And that's the actual document which will really kind of certify the pre-63 status. The declaration is given sworn, it's a sworn declaration that's provided by perhaps the original owner who completed the subdivision. Or it may be given by someone who is some way connected with the property and can vouch for its status as being pre-63 as of the applicable date. So it could, for example, be a tenant who lived in the building at or about that time. But the main thing is that this is your MOT, if you like. This is the document that should be scrutinized carefully to make sure that it reflects exactly what you see on the ground when you inspect the property. So why then, you may ask, many of these properties needing repairs and lots of refurbishments, why would they be popular with today's investor? Well, and for a certain set of investors, these properties have always been a favorite. And over the years, we've encountered many investors who started with perhaps a single house in 5 or 6 units, and through refurbishments and leverage managed to build up a very significant investment portfolio and an even more impressive annual rent roll. In recent years, the circle of interest in these houses has widened considerably, to the extent that nowadays pre-63s are sought by a wide variety of investment groups. And Angus touched on the small self-administered pensions. These are particularly attractive for that purpose because as he pointed out, the rent is not taxable. If it's in a pension scheme, it's not taxable. And over a short few years, you can actually build up quite a pension pot by way of purchasing a pre-63 investment. And of course, it's also exempt from capital gains tax. The funds must stay in the pension, but it doesn't incur the CGT, which is at 33% at the moment. So then you might ask, what other advantages do these pre-63 houses have over other kind of property types? Well, firstly, the pre-63s, I suppose they're well recognized for delivering quite excellent rental yields. Investments such as industrial units, offices, purpose-built apartments will produce yields of perhaps between 4 and 6%. Pre-63 investments are generally capable of producing between 8 to 12%, depending on condition and location. Secondly, I suppose the relative ease by which value can be added to these investments, that's a real draw for investors. Consider a typical pre-63 that you might want to buy. It's in 8 units and it's producing 60,000 a year. It's in poor condition. You purchase it, you refurbish it to a certain standard, and now suddenly the property is earning 100,000 per annum. That's a full 66% of an increase in its rental value. And as you know, investments, their value is largely determined by their yields. So it would have a corresponding dividend in terms of capital value also, even allowing for the cost of refurbishments. That's quite a lot of equity that you've managed to add to a property that over the space of perhaps 3 or 4 months. A third reason why these pre-63s are attractive would be their central locations. The very reason these houses were subdivided in the very first place was to answer the demand for rental accommodation in these locations. And that continues to this day. The demand seems to be constant for accommodation in these areas, and the net result is faster lettings, fewer vacancies, and higher rent roll. Lastly, these buildings, they're self-managed. You don't have the complications of a typical apartment building situation which is controlled by an owner's management company. You don't have the management fees. You are in direct control of your investment. You decide where to spend the money and when to spend it. Contrast that to your apartment building, whereby if you'd like to get some improvements completed to common areas, you might have to submit a proposal to the managing committee. It would go to a vote perhaps at some stage of the year, and depending on the circumstances, it may be approved or declined. That's not the case. In a pre-63, you are responsible for the actual building yourself, and you control where the money is going to be spent. So then, to close, a final question, and for anyone seeking to purchase one of these investments, you may say, well, what regulations and what legislation should I be familiar with if I'm getting into this area? Well, Margaret mentioned the Residential Tenancies Act. That's certainly the manual, if you like, and it kind of governs the way that landlords interact with tenants. The private rental market is a highly regulated area these times. And so the Residential Tenancies Act is an area that investors would need to be constantly updated on. Legislation is changing all the time and at a rather fast pace. The second area, the housing regulations 2019, that governs the minimum standards that you're bound to keep your accommodation in. And because the nature of these pre-63s and repairs and all that, you've got to be conscious of these kind of areas. The local authorities will conduct inspections from time to time, and you will be required to maintain the accommodation in accordance with these kind of regulations. And lastly, and especially in the case of pre-63s, you should be very much aware of your obligations under the Fire Services Act 1981 and 2003. That just about concludes what I have to say about pre-63s. Since COVID has emerged and has been pointed out by other panel members, yes, there have been more vacancies, and especially at the higher end, newly refurbished units which were let at full market rents. These are the ones which have been most affected. However, the more moderately priced units have remained constant in their production of rent. There have been fewer vacancies in these, and rents have been maintained at these levels. So I'll just conclude to say that for any of you who are interested in these kind of properties, and when COVID restrictions allow, and you want to familiar yourself more with these, inspect these properties, and when you're ready and fully equipped, maybe with finance from ICS Mortgages, we'll be happy to match you up with a lucrative investment.
Great. Okay, thanks very much, Conan. We've got a legal question then, so maybe over to you, Breen. As is the case in every aspect of life, conveyancing process in Ireland has had to adapt to the challenges of COVID. Can you describe those challenges and also describe what steps the legal profession has taken to help expedite the conveyancing process during the pandemic?
Yes, I can. Thank you, Fergal, and good afternoon to everybody. Like every other business, at the initial lockdown, the conveyancing process literally fell off a cliff. The first issue, obviously, is that an awful lot of lawyers were not set up to work from home. Simple as that. In our own office, coincidentally, we had all just done a dry run of everybody working from home with laptops. But believe it or not, that was in case of snow and lockdown for that reason. So who would have thought that actually was invaluable for us in our circumstance? But the reality was there was very little transactions taking place for those first few weeks of lockdown. And that's fully understandable that the nation was getting to grips with it. There were things like getting your title deeds from a lending institution. And very understandably, everywhere was on skeleton staff. So that could take what normally takes 2 weeks, could take up to 6 weeks, for example. The unavailability of people to sign documents, directors, for example. The PRA or the land registry was closed for several weeks during the early pandemic. And things like, on one occasion, we were selling a property and the mortgage protection insurance wasn't in place. And because the purchaser, who was getting a loan facility had tested positive for COVID. They had to wait an extra period of time until they were clear. And I understand from today's newspapers, although I haven't read the article itself, that there is some question about people who've had COVID and their difficulties in getting mortgage protection insurance. So all of these unknown items came into the fray when involving oneself in a conveyancing process. And that was not just everybody, that was the mortgage providers, the solicitors being unable to meet their clients, etc. So, until everybody got set up and was available and ready to work from home mainly, things did go very slowly. But look, everybody adapted to it. And I have to say, I think an awful lot of solicitors and legal professionals will have said that their end of calendar year was reasonably similar to previous year as regards conveyancing. The demand was there and transactions did happen. And this is as a result of a number of things. One, an awful lot more firms, because of the pandemic, grasped the whole electronic side of things. And whereas before the pandemic, we would have seen maybe only 40% of the documents coming to us electronically, now we see almost 90% of documents arriving with us by way of electronic transfer or data rooms, etc. So that has sped the process up. Things like electronic signatures are acceptable in most places. Unfortunately, they're not accepted in the land registry, where one would hope that they would be, but this is to do with fraud, and the E-Commerce Act of 2000 prevents anything other than what we call the wet signature or the traditional handwritten signature being used in matters for deeds, wills, codicils, and that type of thing. So that's still there. But, the land registry, to be fair, have come up with a new solution now for lodging mortgages, etc., electronically since the first of the year. So everybody has tried to row in with this. And there's a practical approach being taken by lawyers whereby documents will come, as I say, originally and initially in electronic mode, and thereafter all the hard copy documents will come on the closing or just before the closing. So people take into account lead-in times now, although these are getting shorter, which is great. And yeah, obviously electronic banking has been a feature of conveyancing transactions for some time now. So that continues. So I think in one sense, this pandemic has sped along the process of e-conveyancing after a shuddery stop-start. I think everybody has adapted from all senses and all inputs into the conveyancing transaction, not just legal.
Great. Thank you, Breen. Yeah, no doubt we've all had to adapt. Okay, moving on then. Question for Ronan. Hello, Ronan. Great talk. Do you see Irish people's cultural attachment to their family home as an obstacle to people downsizing and therefore freeing up family homes for the next generation? And arising from this, will there be an insufficient take-up of the apartments necessary for a properly functioning property market? So it's always an issue pops up, our love of the semi-detached houses. So, and can we adapt to the European continental apartment model?
So I see absolutely no cultural factor in Ireland at all. The only reason we live in semi-detached is because that's what we've built. We didn't build them because they're the only things we wanted. We built them because of our unique demographic context. And as proof, right, if you think about three groups of the population, think about the new Irish, so to speak, who have come here over the last 20 years. And you might think, oh, well, maybe they'll live in apartments, but normal Irish people won't. And then you go, okay, well, actually, what about Irish? And you got younger and older. You've got Irish people maybe over 45 and under 45, or over 40 and under 40. Okay, maybe the under 40s will live in apartments, but the over 40s won't. Well, look at who lives in the apartment blocks that have been built in the suburbs in Dublin over the last 15, 20 years. If you look at what's the Fawn Lodge out near the park in Castleknock, or Bushy Park House, or there's a few others in Dublin 4 and Blackrock. They are disproportionate. We can now look at these, by the way, block by block, because the census has a new thing called small areas. And if you look at who lives in those apartment blocks, they're disproportionately lived in by the over 55s. So it kind of blows out of the water this idea that, oh, well, the reason we don't build apartments is because Irish people won't live in them. The very group you think would be least likely to live in them for cultural reasons do actually sell up. Now, there is an issue here around how preferentially treated owner-occupied homes are. With no capital gains tax, no income tax, if you want to hoard wealth, there's no better way to hoard wealth than to have lots of it in your own family home. But lots of people reach a point where that's no longer their only goal in life. So I don't see any blockage whatsoever. I think the blockage is not on the demand side, it's on the supply side. If we build these in the right style and in the right locations, there'll be absolutely no problem with Irish people moving into well-built apartments.
Okay, thank you, Ronan. And not to put you on the spot or anything, but there's another question for you in relation to if you were to invest in the buy-to-let market. I suppose where and what type of property would you invest in?
Oh, that's a good question. I am with two small children and a relatively fresh owner-occupied mortgage. I'll be honest, I haven't given this too much thought. But for me, I would be kind of in the Angus school. I'd be looking at rental yields to be doing the bulk of the lifting in terms of income. I wouldn't necessarily be trying to get something that I think, gamble on. Well, Dublin 8 is going to be the up and coming area, or Dublin 10 is the up and coming area, and you go for capital gains on that. For me, to be about rental income, and it goes back to some of the things that Coleman said. And when we think about preferences about what people want to live in, there's an advantage to living in urban housing where you're within walking distance of lots. So I would probably be biased at looking for something. Again, who's writing the check that I can do this? But if I had the funds, I'd be looking for something within the canals that generates strong rental income, rather than looking for something that's more of a play on capital gains increase. So hopefully, Coleman, I'll be a customer of yours in the not too distant future.
Yeah, great. Thank you, Ronan. So just conscious it's 12:27, and we promised everyone we'd conclude at 12:30. So we're now coming, I suppose, to the end of our event today. I hope you've all found it informative, worthwhile. I would like to sincerely thank Ronan Lyons and our expert panel, Margaret McCormack, Rowena Quinn, Angus Burns, Coleman Connor, and Breen Purcell. Our invitation today stated that Ray McMahon, our Chief Commercial Officer, would be our MC for this seminar. Unfortunately, Ray has sadly had a family bereavement, and we all offer our sincere sympathies to him and his family at this time. This event has been recorded, and we will have the link up on our website very shortly, and you can access the slides as well. If you would like to ask us about any of our buy-to-let mortgage products, you will get all our contact details on our website, icsmortgages.ie/buy-to-let, or contact your local mortgage broker. So finally, it's been a real pleasure to host this event, and I would like to thank you all for attending in such huge numbers. And on behalf of myself and the entire team at ICS Mortgages, thank you very much.